What are the different types of installment loans? Imagine borrowing money for something big like a car or your education, and paying it back in steady, predictable payments. That's what installment loans are all about. They're a key part of credit fundamentals and help you build credit history. Knowing the different types can help you choose the right loan when you need it. An installment loan is different from a credit card. With a credit card, you can borrow up to your limit, pay some back, and borrow again. But with an installment loan, you get a fixed amount upfront and agree to pay it back in equal payments over time. This makes it easier to plan your budget because your payments stay the same each month. The most common type for students is a student loan. These loans help pay for college or university. Federal student loans include direct subsidized loans, which don't accrue interest while you're in school, and direct unsubsidized loans, which start accruing interest immediately. There are also direct plus loans for graduate students and parents. Private student loans are available from banks and lenders, often with higher interest rates. Repayment usually begins after you finish school, giving you time to find a job. Personal loans are flexible and can be used for many things like consolidating debt, paying for emergencies, or big purchases. They are usually unsecured, meaning you don't have to put up collateral like a house or car. Interest rates depend on your credit score, so good credit can get you better rates. These loans typically have repayment periods of 1 to 5 years, with fixed monthly payments. Auto loans are used to buy a car. These loans are secured by the vehicle itself, so if you don't make payments, the lender can take the car. Auto loans usually last from 2 to 7 years. They often have fixed interest rates, making payments predictable. If you're a student planning to buy a car, an auto loan can help you build credit if you stay current on payments. Mortgages are loans for buying a home. They are secured by the property, so if you don't pay, the lender can take ownership. Mortgages tend to have long repayment periods, often 15 or 30 years. While most students won't need a mortgage, understanding how they work can be useful for future planning. There are other types too. Buy now, pay later plans let you split a purchase into a few payments, often interest-free if paid on time. Payday loans are short-term, high-cost loans that are risky and generally not recommended for students because of their high interest rates and short repayment periods. Making regular payments on installment loans helps students build a good credit record. Paying on time shows lenders you're responsible, which can help you qualify for future loans or rent an apartment. Student loans are often the first major credit account for many young adults, so managing them well is important. If you're a student, start with federal student loans because they usually have lower interest rates and flexible repayment options. Borrow only what you need and keep track of your debt. Set up automatic payments to avoid missing due dates. Check your credit report regularly to ensure your payments are being reported correctly. If you consider other installment loans, compare interest rates and fees from different lenders to find the best deal. Remember, principal is the original amount borrowed, and interest is what you pay for borrowing that money. Collateral is something of value you pledge to secure the loan, like your car or house. Fixed-rate loans keep the same interest rate throughout, making payments predictable. A grace period is a set time after graduation before you start repaying student loans, giving you some breathing room. Understanding these types of installment loans and how they work can help you make smart choices when borrowing money. Building credit through responsible repayment is a step toward your financial goals.